It's the Radius Podcast, recorded live from New York City. Welcome
to the Radius Podcast here. What is today? Today is Friday, January 24th. I'm joined in the studio by Moe Kruger and Terry Campbell, both from Live Oak Bank. Gentlemen, thank you very much for being here today.
Thank you.
Thanks for having us.
So Live Oak Bank, a lot of lending, a lot of different areas where I don't normally see lenders, but you guys do a lot of really interesting lending, but obviously self-storage is a big focus.
Self-storage is a big focus for our team. That's all we do with our team at Live Oak. We have 30-some different industries we actually lend to and specialize in at Live Oak, and we just happen to be the self-storage team.
Right. I was talking with John Lindsay a few days ago. Lindsay Self-Storage Group gave me a call out there.
Yeah.
But he was talking about how long you've been in this industry, how long he's known you. Help me understand a little bit of your history in self-storage, because Live Oak Bank, I don't know what the history's been with self-storage, but you've certainly been in the industry for a long time.
I have. I've been in the industry just a little over 25 years. It was January 3rd of 1995 when I officially started in the self-storage industry. I was with one of the major self-storage building manufacturers out there, and I grew up in the industry there. I was there for a little over 20 years. Did estimating, some engineering, drafting, that sort of thing, and went into sales, and just over the years worked my way up the ladder. And at one point I had been executive VP of operations and the VP of sales and marketing. When I left, I was over the sales and marketing division when I came to the bank. And while I was there, I was fortunate enough to not only be a vendor to the industry, but I became an owner for the first time. And that facility since has been sold, but it gave me a taste of what both sides of the industry is like.
Right. So I want to get into the ownership piece later.
Sure.
But Mo, what's your history been in self-storage?
So my history has been in banking, roughly about 30 years in banking. And back in 2015, when Terry was started as the general manager for Live Oak, I joined him as putting together the pieces on the banking side. Okay. And so it was exciting for me because I'll often refer to Terry as a walking, talking encyclopedia of storage. So to have that knowledge really was helpful.
So you guys got started in the business in 2015
Right.
on the Live Oak side. Now, has it always been focused around the SBA element of lending?
Well, yes, that's the way it started. Live Oak Bank was an SBA, and still is. We're still an SBA lender. In fact, for the last 2 years, we've been the largest SBA lender in the country as far as dollar volume. But when I started, SBA loans were all that we did. And, Live Oak started in 2008 lending to veterinarians, and they specialized in that. And by giving that focus on one industry, you get good at it. You know what's a good loan, you know what's not. You're able to help your customers. And it's just great in a lot of ways when you focus on just one thing. And they saw, well, wait a minute, this works great. Let's add another industry. So over the years, then they've been adding industry after industry. We were actually number 9 that started at Live Oak, but focusing on the verticality, we call it verticals, and the verticality is what really makes us successful and is attributed to the growth that we've had over the years.
Yeah. No, I mean, singular focus is from personal experience and us, starting Radius, being singularly focused on one industry allows you to really execute because you're focused just on the needs of that particular industry, which can be so different as you go from industry to industry. So I can certainly appreciate that. So 2015, you guys got started up. SBA lending, are you guys doing any on-balance sheet lending, or is it all SBA-sponsored lending? And I'd like to go into the difference between those because I'm somewhat familiar, but I'd like to get your spiel on it.
We are doing more than just SBA. We were SBA 7A lenders, and then we have started and really dived into the world of SBA 504 lending. We do USDA lending. We did a couple of USDA loans last year in the self-storage industry, and we found they have their place, and in some cases it can really work out better than some other loans. So we also do conventional lending, which we've just dipped our toe into that end of the pool, and we're gradually increasing our presence in the way that we're going to market with conventional lending. So being that we focus on one industry, we want to provide as much in the way of options for our borrowers as we can, because since we specialize in self-storage, we know it, we understand it, we can help the customers not just with the lending but also with our knowledge of the industry.
Right. So first time I've ever heard USDA outside of a grocery store in terms of lending. So 7A, 504, USDA, and balance sheet. So you guys are now doing every type of lending as it relates to self-storage.
Sure are.
What are the without boring people that may have already fallen asleep with this conversation, what are the differences between those four?
Mo, you want to take this one?
Sure. So the 7A is really a great product for ground-up construction deals or conversion deals. And the reason I say that is because you're able to structure the deal with, we talk about it being a project, so the elements that go into that project, the land cost, the hard cost, soft cost, we'll build a 10% contingency on the construction piece. We'll put an interest reserve for the construction, interest reserve for the ramp-up, and an interest reserve for the operating deficits. You have closing costs, load up all those, we can lend 90%. So there's a great attraction there from the standpoint of people are able to get into the industry without having to have millions of dollars that they need to put into the project. So I often tell people we really appeal to the hardworking American people that want to get in the self-storage business in a way that they can get into it without having to supply millions of dollars to the project. That's a 7A. The 504 is a great way to finance, I believe, real estate, but in particular acquisitions, because they don't have the need for the interest reserves quite the same way as the 7A. So, and a fantastic rate with the debenture, which is the SBA portion of it. It's a 25-year fixed rate at a very low rate. So a really great option to offer there, especially on acquisitions. The USDA is very similar to an SBA product. Oftentimes you can get a little bit longer term and amortization. It also, not to get too far into the weeds with it, but there's also the element with third-party management where they have a little more flexibility than what the SBA allows. And then, of course, conventional is a great piece for somebody that may not want to take advantages of the benefits of the SBA and are more looking for a conventional piece.
Yeah. The 7A at being able to wrap all those costs into a 90% levered loan, that's big. Is the only restriction that prevents you from taking more of the market, basically that from a third-party standpoint, you have to be managing the property yourself? Because there's some restriction around that in terms of a 7A loan versus a conventional loan, right?
Right.
You can't have extra space come in there and manage.
There's the good part is there are certain third-party management companies that are compliant with the SBA, and so we're able to connect the borrowers with them, and so that's a great opportunity. I think the biggest piece that is missing that we're always trying to advance is the SBA is not for the person as a last resort. The benefits of it really are fantastic, and the ability to get into a project, whereas maybe if you try to do it conventionally, maybe you'd have to take on several partners or other people and give up equity. This to be able to have 100% equity and to really run your show is really attractive. And so I think the biggest thing that we do, and Terry and I started in 2015 with this, our task was let the industry know of the benefits of the SBA and how it can really help them realize their dream of owning a facility.
Right. So from that standpoint, the third party, you still can get outsourced third party, but it just has to be amongst maybe not of a REIT type player.
Correct.
But getting into self-storage development, typically what I've found is that the signer on the debt, it seems to be kind of the choke point to a certain extent because you need somebody with a balance sheet. This is a non-SBA scenario. So in this scenario where you're doing a 7A loan, 90% leverage, what does the financial picture need to look like for the person that is getting this type of loan? I mean, what are the check boxes they need to have from income or what your balance sheet looks like to be able to get a product like that?
So the characteristics of somebody that we like to fund, we always talk about them having the eye of the tiger and be passionate about what they do. And I encourage people when they come to us and they're putting together the business plan, I tell them I require that you really brag about how great you are. And I want to know how involved you're going to be and brag. Leave humility for another day. When they give me their projections, we require feasibility studies, but when they give me their projections, if they give me their worst case scenario, I'm going to hand it back to them because they're not going to put their hard-earned money into the deal to do a worst case job. Give me the numbers that when you jump out of bed at 2 o'clock in the morning, you want to hit those numbers. And that's really what I want. I tell them it's in the DNA of credit guys to cut. So if they cut 10%, credit guys cut 10%, now I have 20% less chance of getting them approved. So it's up to us to really spend time with them. And, part of it that's so great is Terry's expertise on this allows us to connect with the right people on the right projects. And, if we see that they really are passionate about what they're doing, the old adage about betting the jockey, we're going to bet that person.
Okay. So you have the discretion under a 7A loan. If it's a $10 million project, they're getting a $9 million loan from you. They're going to have to come up with $1 million in equity. But outside of that financial requirement of $1 million in equity, passion is essentially the only other.
Passion is important. We want to have them have post-transactional liquidity. So if, something goes haywire, that the project doesn't stop, we want to make sure they have a good credit score. We want to make sure that they're past, that they've, been a high character person. Right. And so we dig into their financial position, their character, their credit. So those things are important for us to really be able to understand not only the project, but the person behind it. And I do think the earlier that we start talking with them, the more value that Live Oak brings.
Right.
Because we can help them with industry experts and people that will help them and maybe some people that they could avoid that ultimately may lead to a financial mistake.
Got it. Okay, so I get a $10 million facility I'm building, $9 million loan, bring $1 million of equity. I have to have some liquidity. How should they think about what that liquidity looks like? Is it a function of the loan? Is it just, they have to have $100,000 of cash in the bank? What's that final piece of liquidity they have to have?
Right. So the easy answer is the more the better. But the real part that we dig into is we want to make sure whatever personal obligations they have, that they have the resources there to be able to take care of that. We do not want that to be stressing the project itself. So I think a good figure would be for their personal obligations, they want to have at least 6 months of that, preferably a year, of resources to cover that, which would be mortgages, car payments, any credit card debts.
So you're talking about their own kind of financial liquidity to make sure
Yes.
that they've got enough money that if things were to change over the next year in their own lives, that they're not pulling money out of what, the attention they'd be given to the project.
We don't want them borrowing that money, and that ends up stressing the project that they're doing.
Got it. Okay. So 7A, has this been your most popular product, that you say, in terms of what you guys been underwriting?
It has been, and a big reason for that is the majority of what we've done over the last almost 5 years is new construction. The first couple of years, it was 90% was new construction, with all of that, of the new building that was going on. And one of the great things about the 7A is that in addition to the minimum amount of equity Mo mentioned, which is minimum of 10, we also can include working capital and interest-only payments to get them through the lease-up period. So in an ideal scenario, they would bring in 10% equity to the table. It could be cash, could be the land that they own. And then theoretically not have to come out of their pocket for another dime. And then once it's time for principal and interest payments to start, the facility can pay and carry itself.
Right. So that comes back to why it's so important that you're modeling out what's going to happen in a as close to an accurate manner as you can, because ultimately you're factoring all of those cash reserves on the debt and on the operating side into the loan, You want to make sure those hit, because otherwise then the person's on the hook for filling the gap, which can be difficult.
And that's a reason that we require a feasibility study. Right. I won't say 100% of the time, but almost 100% of the time, we're going to require a feasibility study on any new construction. And there's a lot of reasons for that. And they need an independent third party to look at this. I know there are lenders out there who, they don't require one, or they say you don't need one. In my mind, that's a big disservice. Yeah. You need somebody who will look at it. A friend of mine who does feasibility studies says you need somebody to tell your baby's ugly, because you get to looking at that facility, you do all this homework, you fall in love with the place, and you're going to ignore things that could affect it. And you need that independent third party who's got experience that can tell you, everything about the population. They're going to tell you the demographics. They're going to tell you about the more important thing actually is they're going to tell you about the competition. What's the competition look like? How full are they? What's their occupancy? What rates are they getting? They're going to tell you all these things. It should tell you what your velocity of lease up should be, what your rent should be, when should you expect to break even, what type of storage should it be, climate, non-climate, boat and RV, what should it be? It is very important that people have that study. And one of the things I like is that most every feasibility expert that I know out there that are really good in this, and they've been doing it a long time, I think most of them use you guys to get their data.
It's a good starting point. We encourage people to start with us, but ultimately, the Bob Coppers of the world and everybody else, they're the best at finding all the little bits and pieces, unit mixes, and all those other things that we don't cover. So it's a good place to start. All right, so 2015, what is, to the extent you can talk about the numbers, I'd like to understand, what does your loan volume look like today, and just talking about the 7A products, that seems to be the kind of the construction product, and with what's going on in the industry, development, construction activity, not that we'd use it as a direct proxy, but how many loans you guys do on the 7A side on construction today versus how many were you doing a year ago, 2 years ago? What does that trend look like in terms of people developing?
The majority of it is still 7A. We are starting to do some 504s. We're doing some USDA. Mm-hmm. The conventional, we're not doing a whole lot of that on new construction now, unless there's a pretty good LTV there. But as far as loan volume, it's still, I think this year we've started off stronger than we did last year. Last year and the year before were pretty, when I say last year, I mean 19, we finished up neck and neck with what we did in 18. 17 was huge. We've done overall in a little less than 4 or 5 years, nearly $600 million and almost 300 loans. And
that's on the load side, so that's 90% of what so that's almost $700 million in actual facility construction. A little more than that. Right.
Because not every deal can be 90%. Some of them are a little more than that. And the feasibility study helps us to determine if we can do as the minimum, which is 10%.
Right. So you talked about 17 going into 18. There was a big difference in volume. Was the change in I think there was a change from the government in terms of a third-party lender, a third-party operator being able to be involved in the SBA loan. So was that the big difference in volume?
Yeah, it was the management.
I kind of, didn't describe it very well. So what exactly happened?
There were two major things that came out in that SOP change from the SBA, which one was basically it was terminology that sort of cut the big boys out, the REITs, out of being able to be compliant to manage or to be eligible to manage. And the other was a 24-month rule, which you have to break even within 24 months of opening the doors. And those kind of go hand in hand because the big deals that wanted the Extra Space and CubeSmart and Life Storage and those guys, those are the big expensive ones, and those are the ones that quite often would take longer than 24 months to break even at a higher leverage. Some of these deals that are put together, with 30, 35+% equity, they're going to break even sooner.
Right.
Just because they don't have the leverage. But with using this tool we have, this product that we have that allows these folks to get in with less money and allows more people to get in the industry, those changes, it took them out. So, I mean, our volume went down almost 50% just because we were doing so many of those.
Right.
I think at that time we had close to $70 million of deals that were in closing that were going to be managed by CubeSmart or Extra Space.
And were those grandfathered in, or did those deals?
Some were, but we had to try to make adjustments, and fortunately, most of those we did get to the finish line. But some of them, they are down the path, and CubeSmart and Extra Space they're great. Right. So then they were a great partner to us. So that was a tough one for us to swallow.
Yeah, I bet that must have been a tough email for everyone to see.
Yeah, especially for the borrowers that were really wanting to do this.
Yeah, I bet. So 2020 started off higher than 2019 on the lending side. Do you think that's going to keep up that pace as we go through 2020? Or
I think so. I think that with let's say the different products that we bring to the market, I think that certainly helps us in terms of really understanding the borrower's hot buttons and then doing a good job from our part to explain to them the pluses and minuses of each deal. That I think we are able to connect with them on just about every type of financing that they could need. So I think 2020 I'm very optimistic about 2020.
Right. So 2020 is looking better because you're finding more products to solve more problems for your borrowers. But if I just isolate construction loans, because using construction loan activity from you guys as a proxy, do you think that number is up on a year-over-year basis?
It's probably similar to what it was. I think we're seeing more acquisition opportunities. There's still a lot of construction opportunities that are showing up. Some may not work. It's crazy, this cycle has gone on. Like I said, I've been in the industry 25 years, and 20 that was with a building supplier. Never seen a cycle go this strong. Every year, everybody's pulling out their crystal ball saying, okay, is this the year? And more and more people are getting on the train right now saying this is probably the last year of this kind of growth. It's got to slow down at some point. I know we had a huge run because of the recession. A pent-up demand was created during the recession. Nobody could get money. And in addition to normal growth, we've been trying to chew through that and put that supply into the market that didn't make it during the I almost said depression, but recession. So I think we've chewed through that. We've got normal growth. I think it's got to slow down at least by the end of this year or the first of next year. And in talking to some of the feasibility experts, they're telling me, look, we're turning more deals down. That it's just you shouldn't build there. And, you're seeing compressed rates in a lot of market because so much supply is coming online that's been in the pipeline. But I think we may see more, and we are seeing more acquisition activity, and that's kind of probably what we'll be focusing on more because we just think that's the cycle of construction is going to slow down. We're going to focus on newer products like we're doing to get more of the market share of construction that's out there, plus the acquisition.
And I think that with Terry, his relationship with so many of the, let's say, feasibility study experts, we're able to align ourselves with the right people that will turn down deals to say, hey, don't do that. And the dangerous ones are the ones that everyone works. And, because Terry preaches to us every day about we've got to be good to the borrowers, to the bank, and to the industry. And if we're doing deals just to do deals, ultimately we're doing a disservice to the industry. And so that's a really big hot button for Terry is let's look at it from the big picture. Right.
Is it a deal we want to do because it makes sense, or is it because we're trying to grow our business?
Exactly. Just trying to throw numbers up on the board. Because, if a deal goes bad, if it gets, they get the loan, they build it, and it goes bad, okay, especially if it's an SBA loan, we've got the majority of it, it's covered by a guarantee. Then there's a portion left over. We sell it. We do whatever we have to do disposition-wise, and then at the end of the day, we write it off. Well, that customer it's going to ruin their life for a long time. They're probably going to declare bankruptcy. it is not going to be nice. And we don't try to just put numbers up on the board.
Yeah.
We want them to be successful. And again, like I said, I'm very careful about trying to protect the industry. But, we just don't want to put people in that position of ruining their life.
And one big thing with Live Oak that's very different from other banks, and I'd say most banks, there's not a single person at Live Oak who's paid an individual commission on a deal. And so, I refer to that as a poison pill, where somebody's thinking, I'd spend a little extra on Christmas, so maybe I can up the rate a little bit, maybe I can do this or that in order to put more money in their own pocket. Live Oak, that's eliminated. We're all part owners of the bank. So to be able to talk to the person and really look for their best interest, the bank's best interest, I think that's what really resonates with a lot of the people we talk to.
Yeah, alignment of incentives makes total sense.
Right.
I was on the lending side at J.P. Morgan when I first got in. Well, right after the mortgage crisis, I was lending to people, and that was the one thing that I loved about lending is you had two perspectives you were trying to solve for, and if you were doing it right and you enjoyed the job, it was obviously you wanted to get it done for the borrower, and the banker coming to you just wants to get it done because they want to get it done.
Yeah.
But you had the credit officer on the other side of it,
Yep.
and you had to sit down with them and look them eye to eye and have a conversation about whether the numbers you're putting in front of them are real, whether the expectations are real, and balancing that risk that the bank's taking versus trying to get something done for the client.
And the credit guy, when you go talk to him, he has the same motivation that we have in originating loans, where he's not just saying no to everything. So you can freely talk to the credit officer and say, here's some things that I think you're going to have a little difficulty with. What would it take for you to get comfortable?
Yeah.
And, so it's everybody's rowing in the same direction. And, ultimately, I think it's very efficient.
Yeah. Yeah, that's one thing I loved about being in the credit business is that balance between doing what's right for the balance sheet versus trying to get it done for the customer.
Mm-hmm.
So with the deals that are not making it through, whether you're talking with the feasibility guys or whether it's you're not getting them done internally, what are the kind of the top three factors that are creating issues? I mean, there's on the construction side, there's input costs, steel, labor. There's the rental rates. Are they just not penciling? What are the biggest factors driving deals to kind of fall flat today versus where they were getting done maybe a year or 2 years ago?
It's the rates. I mean, you're getting an oversupply in certain areas and just not getting the rates. Steel supply, that's not been an issue in well over a year. We did have that. I've lived through that 2 or 3 times. And it's not fun in any position you're in, the supplier, the bank, the borrower, anything. But steel is not really, it's been fairly stable.
Mm-hmm.
We definitely make sure that the customer knows, how long is your product locked in for, what's your price going to be, how long is it locked in for, and when will it change? And we try to make sure we work with them on that as well. But I'd say mostly it's just, you're seeing rate compressions in certain areas that, or new competition that's it's not making it work.
Right. So rates are the biggest thing when you're seeing guys come to you saying, I can't get this done.
Yeah, I think so. One that I remember over time, we had one that, we had 2 family members. It was a project that we thought was pretty good. So we were really trying to work with them, and through our process and the work that we put into it, we did find out that a competitor was going to be opening up within a mile of where they are. And as we dug into it, and again, Terry, knowing the industry, knew the reputation of the person who was building the facility, knew he's a bit of a bully. And so we advised the borrowers, potential borrowers, to either find a different location or to hold off on it.
Right.
And again, it's sometimes the best thing we can do is advise them not to go forward with it. It hurts, doesn't feel good, but ultimately, as Terry talked about, it causes a real bad situation for the borrower. Then you got, spouses, children, employees, spouses. And so I've seen our credit guys almost come to tears that if a deal goes bad, that they didn't do enough to see something that could happen. And again, it's I think just something that Live Oak stresses is let's do what's right for the borrower, the bank, and the industry.
Yeah. Yeah. So you guys talked about, being stewards of the industry. It's because you're an owner. You have been an owner. Are you currently still an owner yourself in the industry?
I am. I partnered with a group in Florida, and we opened a pretty large facility last May in Florida. So I'm a partner in that facility and partners with some other folks. We just closed our third project acquisition, looking at the fourth one right now, and I wanted to have a little bit of balance. I wanted to have a new one that we built from the ground up and, experience the growth and the equity from that type of investment. And also with the ones we're involved in now, we're buying facilities that have a major value add.
Yeah.
You're full, you haven't raised rates in years, you have no presence on the web, you have no credit card. I mean, things and room for expansion. So we're looking at those things where it's cash flowing day one, the day we close on it, and all we do is go in and just add value, create cash flow. Maybe it's someday, we'll sell it, maybe not. Our intentions is to sort of build these things up for a retirement account.
Yeah, I mean, that's where we see. I hear most people talking about, where all the capital's going now is everyone value add. But that seems to be the hot button in terms of what people are trying to go after.
That and we try to the group that we own the three with. Another thing we do is to operate unmanned. It may be manned when we buy it, and then we slowly convert it over to unmanned because that's a major value add. And there are just so many ways now that you can operate without an on-site full-time manager.
Right.
In certain projects.
Right. Yeah, I mean, it really matters on whether the facility has enough scale, because on the other side of that, one of the things that I've talked with a couple people about in the last couple weeks is you have to consider the upside that a good manager can bring from a revenue perspective of being a good salesperson, not only from upselling on price, but being able to sell on tenant insurance. A lot of that upside can be more than offsetting to whatever savings on a automation standpoint. So automation is obviously, for guys like Red Dot that are just taking these 30, 40,000 square foot facilities, they don't have enough scale to even have a manager there. That makes a lot of sense. But on the other side of it, it's not going to be completely automated because there's just too much value to having a really good salesperson at the front office.
Yeah, it's becoming more and more popular, and it's right in certain cases. Certain it's not. I mean, the one in Florida, we built to 122,000 square feet. We're not going to operate that one unmanned.
But we've seen, I mean, it's funny when you talk about the manager. We went up and saw one in Ohio, and we were with the buyers. And so it was currently, in the seller's management, and the manager came out, and he had a T-shirt on that looked like it hadn't been washed for probably 3 weeks, and it said, "Don't make eye contact with the animals." And I said to the buyers, I said, we got to get you closed as soon as possible, because if they can even be breaking even with that type of mentality, imagine how you can do. Subsequently, this is one we did about 3 years ago. I think they've doubled the value of it. They've really done terrific.
Oh, yeah. They took it, it was like $14,000 a month. The top line they were bringing in, and then after a year and a half, 2 years, it was $33,000 a month.
That's insane.
Yeah.
How many of those in the acquisition side, because you guys are seeing the numbers come through, how many of them are of existing facilities would you say are true value add versus someone that's just doing it for maybe some other reason? I mean, there's still a lot of value add opportunity out there.
I think so. I mean, we really encourage people. It's kind of right out of Scott Meyer's playbook. Is I'll tell people, don't neglect looking to buy when you drive up to the facility. Your car on its own makes a U-turn, because you can tell the grass needs a haircut. Maybe the gate needs some work. Just everything. If you go in there with some common sense and just some, good old-fashioned, let's take care of the customer, immediately the facility the value of it will be increased. So I think there's still ones that people that don't understand that those could be the real gem. They'll just drive by and look at the shiny new one. But I think the industry now is at such a position that the guys who have the shiny new ones know what they have. So if they were to sell, they're going to sell it at a pretty big premium. You don't want to get into it just to break even. Give yourself a chance to make money. So don't overlook the opportunity to buy one that's slightly off the beaten path, that you go in and do some, some minor type of changes to it and make it very successful.
Yeah. I mean, that's the question I have is how long there's going to be these opportunities like this, because inevitably it's like the last real estate. I mean, you have mobile home parks, so I wouldn't say the last real estate sector, but one of the last real estate sectors that really has yet to fully consolidate. Because once it does, I mean, then you're not going to see these amazing opportunities to just buy facilities that the guy may have been getting, like you said, $13,000 a month, and that paid his bills, and that's all he cared about. He's not going to increase rents because he just doesn't want to lose customers and go through the hassle.
Exactly.
But how long does that go for? How many years of that do we have? And that's
a very good question.
Yeah,
because you got folks out there all over the place now trying to find these deals, and you got owners who won't answer the phone. They won't answer a piece of mail. You try, and then at some point in time, they're eventually going to say, I just want out of it. I don't want to deal with it at all, even though they're not really dealing with it now. They don't want to deal with it all. And then those will trickle out, and it may be another 20, 30 years before some of those people finally give up and say, I'm done here, you can have it.
Yeah. We have one right now. It's a repeat customer. They're buying a facility right across from where their current one is. They built this one back in 2015, I believe. And so they bought this. Great fit for them because this was the one that was driving costs down in their market. And when the buyer, our borrower, would go over and meet with them, said it was not uncommon for them, the phone to be ringing, and then just unplug the phone because they didn't want to do business that day. They have one unit that's pretty good size that I look at and I said, why are they getting $0 for this unit? Oh, they exchange it for local Chick-fil-A lunches during the month.
Well, that seems reasonable. I love Chick-fil-A.
So everybody can get creative.
I think I have this Pompano taco place around. I eat there 4 times a week. So if they're getting 4 or 5 deliveries from Chick-fil-A a month,
well worth it.
Then maybe they're making out on that.
They may be.
So I'd go back to the numbers on that one, Mo.
Keep that in place, yeah.
All right. Well, I don't. We're almost at 40 minutes, and at this point in the podcast, if there's anybody that's still listening, then they're probably one of the last few.
Right.
But Mo, Terry, thank you very much for coming in
and
joining us today.
Yeah, thanks for having us.
It's some great guys in the industry, big supporters. Terry was on our bandwagon right from the beginning, and for small business, it's been a world of you just can't thank you enough for that. So thank you very much.
Absolutely.
And Mo, nice to have you in the office.
Great. Yeah, thank you very much.
That's it. So.
You've been listening to the Radius Podcast. Don't miss a beat. Subscribe today and stay up to date on self-storage. And come and hang out with us at radiusplus.com. We'd love to hear from you.